Are you ready to uncover the financial magic that powers towns, governments, and businesses? Well, get ready because we're about to unlock the secrets of bonds, the financial superheroes of our economy. Bonds are like financial superstars, the funding heroes for towns, governments, companies, and more. What makes bonds stand out? Well, think of them as supercharged loans that you can buy and earn from. Plus, they come with a due date when all the borrowed money needs to be returned, along with some rules about interest payments. So if you're curious about the fascinating world of bonds, keep watching. We're breaking it down for you. These bonds from corporations or governments are like tradable certificates for debt. They are stable and predictable, unlike the up and down earnings of stocks. Think of them as a calm river in finance. When interest rates drop, bond prices rise because borrowers seem reliable. On the other hand, high interest rates signal risks, making bonds less valuable. Bonds also have a maturity date, when they disappear and a borrower must repay everything. Let's talk about bonds and why they exist. Bonds are financial tools that companies and governments use to raise money without giving up ownership, like they would with stocks. Imagine this: when a government needs money for a big project, they issue bonds. Investors buy these bonds and get guaranteed payments from the government. Government bonds are usually safe because governments are known for paying back what they owe. But with companies, it's different. Companies can go bankrupt, and if they do, their bonds can become worthless. For example, if Apple issues a bond, it would attract investors because it's considered safe. But if a company like Blockbuster issued a bond, it would be riskier. You might wonder why companies don't just ask banks for loans. Well, sometimes they need more money than a bank can provide. In those cases, they use bonds to raise extra capital. Now let's dig into how bonds work after understanding why they exist and who uses them. Bonds are a type of investments like stocks, but with some key differences. First, bonds are generally considered safer than stocks. Instead of aiming to buy low and sell high, as with stocks, bonds offer a more predictable way to make money. They make regular payments and have an expiration date when investors cash in. You can buy bonds in the public market or through private deals, depending on how they are set up. When you buy a bond, you're not just getting a piece of paper, you're entering into a deal with terms and clear plan to get your money back. This plan includes details about the loan, the interest payments you will receive over time, and the maturity date, the day when all the borrowed money must be returned to the investor. Here's how you make money with bonds. You receive regular interest payments, which are like the icing on the cake, in addition to getting your initial investment back. These interest payments are known as the coupon, and the interest rate is a coupon rate. Bonds typically start at either $100 or $1,000, called the par value. But here's the twist: their prices can change as people buy and sell them. If a company issues a bond when they're doing well but faces challenges like a pandemic later on, the bond's value can drop because investors may lose confidence in it. When a company or government issues a bond, it's like they're borrowing money from investors. If things go wrong for the issuer, it's the investors who might lose money, similar to stocks and other investments. Now let's talk about what makes a bond valuable or not. There are three important things to consider. First, the credit quality of the organization matters. It's like a measure of how reliable they are at paying back what they owe. Second, you should pay attention to the time until maturity. This is like a countdown to when the bond will be paid back in full. Lastly, the coupon rate is crucial. It tells you how much interest you will earn. You want this interest rate to be good compared to what other bonds offer. Here's the interesting part: you don't have to keep a bond until it matures. You can buy a bond today and sell it next week if its prices go up. Or you can choose to hold onto your bonds, let them collect interest over time, and slowly get your money back. Now, let's dive into some more details about how bonds work. The face value of a bond is how much it's worth when it reaches its end date. For example, a bond with a face value of $1,000 means that when the bond matures, the company or government that issued it has to pay you full of $1,000. The coupon rate is the interest rate the issuer promises to pay. If it's a 5% rate on a $1,000 bond, you'd get an extra $50 every year on top of the $1,000 you get when the bond matures. Coupon dates are when they pay that interest, and the maturity date is when the bond ends. The issue price is the initial price the issuer set to buy the bond from them. Two main things determine if a bond is good: the issuer's credit quality and how long it takes to mature. If the issuer has bad credit, they must offer a higher interest rate to attract investors. Bonds that take a long time to mature also have higher interest rates because it takes longer to get your initial investment back. Safe bonds are called investment-grade bonds, like US government bonds and strong companies. Risky bonds are high-yield bonds or junk bonds, with higher interest rates but a greater chance of losing all your money if the company fails. There are a few different types of bonds, each with its own flavor. First up, we have corporate bonds. These come from companies, and when you invest in them, you're essentially lending money to a business. Then, there are municipal bonds, which are issued by states or cities. When they need cash for things like building schools or roads, they turn to these bonds to raise funds. Government bonds are another category. These come straight from the national government or a central bank. They are seen as quite safe because, well, the government isn't likely to go broke. Now, agency bonds are a bit different. They are issued by organizations that have some kind of connection to the government, so they're also considered pretty safe bets. But there are some bonds that don't follow the usual rules. Take zero coupon bonds for instance. They are unique because they don't pay interest like regular bonds. Instead, they are sold at a discount, meaning you buy them for less than their face value. And when the bond reaches its end date, you get the full face value back. It's like getting a deal on your investment. And lastly, convertible bonds offer an interesting twist. You can turn them into company stock down the line, depending on the stock's price. This can be a win-win. You might accept a lower interest rate now in exchange for the possibility of owning more valuable stock later on. So, these are the various flavors of bonds in the financial world. Consider a regular bond with a 12% interest rate. It's like an annual promise to pay you. Now, a convertible bond might offer less interest, say 8%, but it lets you convert it into company stock if the stock price reaches a certain level later on. It's a bit of the trade-off. Then, there are callable bonds, which companies can buy back if they find a better interest rate. And putable bonds give holders the option to sell the bond back to the company before it matures. Now, let's discuss bond pricing. Bond prices, like other things you buy or sell, can change. When a company does well, its bond prices tends to rise, just like its stock prices. Conversely, if a company struggles and loses money, its bond prices can drop, similar to its stock prices. This all comes down to supply and demand, what buyers are willing to pay for bonds, and what sellers are willing to accept. Bonds are loans regular people give to borrowers, and they can be stable but also carry risks. Understanding bonds is key in today's economy and investing world. Stay tuned for our next video, where we will continue to demystify the world of finance and investing. Until then, stay curious, stay informed, and stay financially empowered. Thanks for watching.